Hi, and welcome to Survey Says Wednesday, where we talk macro, try to make sense of markets. Can they make any sense when the NASDAQ hits new all-time highs as Apple closes stores? I mean, come on. And answer your questions so we can become better investors. I'm your host, Steve Van Metre, and thanks for joining me today. I got a great show lined up for you today. Now, a couple announcements for you. I was interviewed by Martin North, I'm going to get this correct, of Digital Finance Analytics on his YouTube show, Walk the World, on Monday, and the show went live last night. So I'm going to put a link in there. It's a nice 20-minute interview. We talk about monetary policy, some other things. He's an Australian YouTuber, and I would love it if all of you would give him a click. I know I asked almost nothing of you, nothing at all. So if you would, when the show is over, I'll have a link in the description. Click over there, and if it's in your heart, throw him a message in the comments so that he'll have me back. His show is much larger in terms of audience than ours, but of course, if we can kind of expand the reach of the macro world that we do here, I'd really appreciate it. Second announcement is some of you have asked for maybe some deeper content, perhaps some even political commentary. Well, Chris Dark, big friend of the show, and his podcast, Dr. Dark After Dark, had me on last night, and we spent an hour. And our goal, we did have an agenda, but we threw the agenda away and said, let's just kick the ball and see where it goes. And we hit politics twice. You want to find out my off-the-wall thought of how the election is going to play out? Go check it out. We talked about third quarter earnings and economic expectations. We talked about boomers and millennials. I mean, we just kind of went all over the place. And we're just really curious. Is this something you want? Because we really had a lot of fun doing it. And it's not something I think a lot of macro people do, because most of the interviews are, I don't want to say scripted, but you kind of know what the questions are ahead of time. At least the interviewee does. They know what they're going to ask. And we didn't do that. And so it's about an hour long, so it's pretty deep. Some just kind of crazy off-the-wall stuff. Maybe, what goes on between Steve and Chris when they're laying in bed at night thinking about the macro world. What troubles them? What are their kind of far-out views that could play into their thesis? And I think this is what you're going to get. If you have any thoughts about what your opinion is, I'm going to link Chris's Twitter feed, which is really the best way to reach him, is to send him a message on Twitter. If you don't use Twitter, you can always post in the comments or send me a message and I'll forward it over to him. But I'll also link the podcast there for you to take a look at when you have time. But of course, we're going to check out Martin's page first. So I appreciate it if you do that. And again, let him know. So hopefully he'll have me back on. Now let's get into the data today of what's going on. I want to talk about the meeting notes from the Fed before we get into the factory PMI data that came out starting Monday night and into today, because there's a lot of really interesting things in terms of, is the economy recovering? Because it's really in the macro world what we're trying to look at. Are stocks just massively overvalued, or is the economy just shooting up to catch up, or is it the other way around? Is the economy really weak and not really showing any signs of growth, and the stock market is just out in another reality, waiting for a big reality check to come in? Well, the Fed meeting minutes were released, and what's interesting about Fed meeting minutes is they're often revised. Now, we don't know that specifically because we're not there when the revisions are made between the actual meeting minutes and the meeting minutes are released. But we do know for a fact the Fed uses their minutes as a form of forward guidance. So let's say Fed Chair Powell comes out during his presser and says some things and the market really doesn't like it, or people have an adverse reaction to it. Well, he can clean up the minutes a little bit to make it look like that maybe whatever he said that day wasn't really what they were thinking. And that's important. Because one of the things they mentioned in there is yield control curve. And they mentioned that they really need to do a lot more research into it, kind of suggesting it's not going to happen because their primary focus of their tools, they said, is going to be jawboning, forward guidance, our favorite thing, because it's working. See, the Fed just does whatever works. And as long as they can talk you into buying stocks, well, they're going to do that. They're still going to do quantitative easing, but yield control curve, probably not coming anytime soon. And again, the best way we can look at it is, again, Japan used it to bring yields up. not down. So everyone thinks that, oh no, the Fed needs to control yields to bring them down. Nah, that's what quantitative easing does. So let's take a look at the data. I want to spend quite a bit of time in this because I think there's a tremendous amount of value in interpreting the economic data. Now, out of South Korea, we have some May data. I'm not really concerned about the May data. We should expect it to be pretty bad. The industrial production on a year-over-year basis was down 9.6%. What we want to start to see, because the U.S. economy opened, kind of mid-late May, is we really are interested in seeing what is the June data going to tell us. Are we really going to start to see a recovery in here? So let's take a look at, let's see, preliminary industrial production for Japan. Industrial production forecast 1 month ahead Japan, and they're predicting for June a 5.7% increase. And in July, they're predicting a full recovery at 9.2%. Now, keep in mind, Japan's in a recession. I'm going to guess these forecasts aren't going to happen. We'll see. I mean, when you see their factory data, you're going to be like, man, there's some really optimistic people in Japan right now. So how about the Chinese PMIs? Now, these are the first ones that come out. And we almost have to take these with a slight grain of salt because we do know China does manipulate the data, but we're not finding a lot of manipulated data in here. Let's take a look at the manufacturing PMI first. Now, printed at 50.9, and anything over 50 is an expansion. Now, the closer it is to 50, the less expansionary it is. So if we're looking for a V-shaped recovery in the data, we'd want to see 60 to 70. We want to see just light out, big number. So at a 50.9, it tells me effectively no change. And this goes back to the February data, and we got this massive drop at 35.7. And what were the following data prints? 52, so slight improvement. Now, all this is telling us is there was a big crash in the manufacturing index in February. In March, slight improvement from the low. April, no change. May, no change. June, no change. What it's telling us is the factory sector in China is not in that great of shape at all. How about the non-manufacturing PMI or services sector? It had a slight expansion of 54.4, maybe slightly above slight. So that's pretty good. Now let's go back. It just cratered at 29.6 back in February. How about the next month? 52.3, slight improvement. 53.3, slight improvement. Then 53.6 and 54.4. So they saw slight improvements 4 months in a row. It does not mean that the services sector in China is back to normal at all. It just means from that deep low, it is slightly improved every month for 4 months. And it's important. That's how you read these and why these PMIs are so critical in identifying are we in a V-shaped recovery? So you can look right now at China and say, no V, not there. Again, survey says. So let's keep going on and see what we can find. Preliminary French CPI slowing down from 0.4 to potentially 0.1. So again, that's a disinflationary potential print coming. That's interesting. There's no year-over-year on the French PPI there. Let's see, what do we got? Italian CPI year-over-year in June. Preliminary is looking at no change at minus 0.2%, so that's still deflationary. How about core CPI, which is usually excluding food and energy out of the Eurozone, slowing down from 0.9 on a preliminary basis to 0.8, disinflationary. The CPI index out of the Eurozone is suggesting a little bit of inflation from 0.1 to 0.3. Italian PPI on a year-over-year basis in May, so coming out of the factory is minus 5.3%, again, deflationary. Let's keep rolling forward and see what we can find. Redbook weekly same-store retail sales. I really find this interesting, and Chris and I, maybe Dave Rosenberg, are the only three people that look at this, I believe. But it's telling us that things are pretty bad. If we go down to the chart and we max it out, what you can see is same-store weekly retail sales on a year-over-year basis worse than they were at the depth of the great financial crisis. Worse, and still worse. So there's no sign of recovery in same-store weekly retail sales. Is that going to indicate that the government data is wrong? We'll be curious to find out. Home prices went up a little bit. That baffles me to no end, but nevertheless, I believe the housing will too find its deflationary pulse at some point. The Chicago PMI. Now, this is a really good purchasing managers index to take a look at because it covers the Chicago region. There's a lot of manufacturing that goes on in that area. So let's take a look at what's going on here. It came in at 36.6 and it was projected at 45. So what is said, at 45 you have, say, a slight contraction. At 36 you have definitely a contraction. This thing is definitely in contraction from the prior month. Well, what was the prior month? 32, contraction. Month before that, 35, contraction. So starting in April, it contracted. In May, it contracted worse. It was like it got hit and it got hit even harder. And then this month, it still contracted from the contraction, which contracted from the contraction. So what it's telling us is the factory sector in Chicago isn't a V recovery. This is what Chris Dark calls your H recovery. Not even an H. It's just kind of just keeps going down. So the factory sector in Chicago, no V-shaped recovery. Now, consumer confidence has improved a little bit, according to the conference board. Let's see if we can pull that up. And a lot has been made that consumer confidence is shooting up, but really it's just a fish hook. It's just following kind of everything else. What's notable is that usually consumer confidence follows the stock market higher, and this time it's not. So will the stock market come nose down to catch back up to consumer confidence or not? That'll be interesting to see. But so far, consumers, while they are more optimistic than they were last month, they're not super rosy about the outlook of what's going on. Let's keep moving forward into the Japan Tankin quarterly survey. Now, this is pretty interesting. This hasn't been around a long time, but the big manufacturing outlook is pretty much telling us what we already know about Japan. And again, this hasn't been out a long time. This survey's been around since, at least the data here, since 2014. This is the worst print in history of this index. It's telling us that not only is Japan in a recession, but there's no way out for them. How about their small manufacturing index? Let's take a look at that. Same story. Worst print in history. Everyone thinks the U.S. economy is going to boom and recover, but how are we going to do this without Japan? I kind of wonder how we're in a global or interconnected global economy and we're going to leave Japan behind. How about South Korean exports? Now, these are from June. So less of a contraction, but still minus 10.9% from a year ago, and imports are down 11.4% from a year ago. So let's zoom in on the export chart just to take a look and see if we get that fish hook. And sure enough, we're getting what appears to be a fish hook, but the trend in South Korean exports is lower. So it's a little bit volatile here and there, but the trend right now is lower. And that tells you where South Korea exports. Well, it exports to major consuming nations, the United States being the biggest. Let's keep rolling on. How about the manufacturing PMI of June in Japan? Well, we probably already know what that's going to print. Printed at 40.1, so contraction. Previous month, 37.8 contraction. So this thing has just been in contraction going back since, it's been slightly contracting pretty much all of 2019. And again, not showing any improvement. The two prior months at 38 and 37, and then this print at 40. Again, those are month over month saying, so you get contraction on a contraction, and then another contraction. Whatever's going on in Japan is bad news. All right, let's move into today's data and see what we've got going on. Let's see, not worried about Russia. Spain, manufacturing PMI in June. No change. So it went from 38, which was contraction, to 49, virtually no change. So no improvements in the Spain manufacturing sector. How about the big German manufacturing machine? Big contraction at 36.6 last month. Slight contraction at 45.2. So no recovery going on in the German manufacturing engine there. How about the Eurozone manufacturing PMI, 39.4 the prior month. So definitely a contraction. Slight contraction at 47.4. So again, no improvement in the manufacturing sector anywhere in the world. Nowhere do we see anything. And we can zoom into the Eurozone and see this thing got cratered. It went down to geez, 33 in May, or wait, early May, and then confirmed at 33.4. Ouch. So big drop, and still contracted all the way through June. Ouch, ouch, ouch. Let's get into the U.S. data from today. Mortgage applications down slightly at 1.8%. I am really interested in this because there isn't enough new mortgage applications to drive the housing market as we look at on Friday, which entered a contraction on a 90-day basis. So this will be really curious to see. This thing needs to be shooting way up, and I have a hunch it's going to start going the other way. Challenger job cuts. Of course, let's be real. I've had that hunch for a while, and I've been wrong. Challenger job cuts. These are announced job cuts, usually by major corporations. In June, they announced 170,000 jobs will be cut. Doesn't mean they were cut in June. It just means they're going to be cut. Forget the ADP non-farm employment report. ADP is all over the place with their predictions, which is odd because they actually do payroll. You would think if they actually are running payroll, they could have a fairly accurate number. All over the place. All right, into the U.S. Manufacturing PMI for June. Let's start with the market, M-A-R-K-I-T, and they are not the official. There's no official one, but the ISM is a more official. So let's take a look at this. This thing got crushed to 36.1 back in May. It was already heading slightly contracting, but in May, massive contraction. And then here we have the June data coming and showing no change. This is how you read this. At 49.8, no change from the prior month. That signals no recovery according to market. How about ISM? Looking at the manufacturing PMI in June, slight recovery, slight to 52.6. So this is very slight improvement over the previous print of 43.1. So you see a contraction last month at 43.1. A contraction. So let's still go back to May. May was 41.5, contraction. It further contracted in June, and now we're looking at the official 52. So that's pretty interesting that virtually no change over the prior months here of what's going on. And that is not good. Not good for the U.S. manufacturing sector. Construction spending. Oh, you know what? I am pretty interested in construction spending. If so interested, I have some charts for it. So let's see. Construction spending was down 2.1% in May. Now, I know it's old data, it's May, but construction spending is pretty interesting, and I like it because normally it predicts, and I've got unemployment claims inverted or unemployment level inverted, and usually construction spending predicts where unemployment is headed. In this case, unemployment is leading construction claims, and construction is sitting on a year-over-year basis virtually at no change, at plus 0.3%. So almost headed negative, not good for the economy. When we look at the non-farm payroll report, again, non-farm is leading it too. Normally, the construction spending leads it lower. Not this time. And how about inflation, the consumer price index? Well, as construction spending falls, guess what? So does the CPI. So do we think construction spending is bottoming out? Probably not, given the state of the U.S. economy and how the virus is spreading. So crude oil surprised the markets by showing a sizable drop, minus 7.195 million barrels. I did not look at how crude closed today, and it closed, looks like down for a little bit, which is interesting. The next couple weeks are big driving season. So usually you see huge crude oil draws. And so we'll be curious to see if we see that repeat this year. We're not seeing big, inventory draws though. So let's take a look at the inventories. And if we look at gasoline, inventories rose 1.2 million barrels. So again, here we're heading to this massive driving season, and gasoline inventories should be heading much lower. How about distillates? They should also be falling. And where are they? Production, inventory, stocks here, minus 593,000 barrels. Again, not major draws. This is your airplanes, distillates, diesel fuel. So not a lot going on, at least in the production side, but crude oil inventories did draw. But we'll see what goes on next week and the weeks that follow. Let's take a look at what's going on with the Federal Reserve. I want to look at the the QE auctions. So when the Fed does this quantitative easing purchases, they're not auctions that you or I can go to, but they're an auction with the bank. So the banks bid on them. So that's why if you're like, why do you call them auctions? Well, because technically the banks are bidding on them and the Fed takes the highest bidder. So let's look at what's coming up. So we're on the New York Fed website, and let's go over here to Treasury Operations Schedule, and let's see what's going on with the Fed. Now, today was the last day this week, and they purchased 7 to 20 year coupon in an amount of $3.625 billion. Now, there are no purchases the next 2 days. If you're wondering why, it's simply because a lot of hedge funds, big traders, bank executives, they're all headed out for the July 4th weekend. They always leave early. So there's usually not a lot going on in the market. So the Fed says, fine, no problem. But look what's coming next week. So next week we get on Monday a massive $12.8 billion purchase of 0 to 2.25 coupon maturity bonds. 2.25 years. And then into next week we have two 20 to 30 year on the long bond at $1.75 billion. So the Fed's definitely keeping an eye on the long end of the curve, and it's doing quite a bit of purchasing there. And then on Wednesday, you have a $6 billion 4.5 to 7 year maturity coupon. So there's a lot of buying next week. And then on Friday, we'll probably look at the schedule and see what's going on. Nothing really interesting in the mortgage-backed security. They're pretty consistent buying a lot of 30-year mortgages. Again, trying to push rates down. That's the whole point of how all that works. It's what QE does, is it brings rates down. All right, so let's go take a look at some charts, and we'll try to grab a couple of your questions and see where we go. All right, to start out, let's take a look at interest rates. And I did meant to look at this the other day, but five-year yields broke a new all-time low on Monday, started a new all-time low on Tuesday, and then sellers pushed them back up today. This is a major topping pattern, and I drew that line here. This is a huge topping pattern that, maybe we get a false breakout here, see if sellers can drive it up. I don't think they're going to have much luck against the Fed. But again, 5 years are pointing to 0%. Now let's take a look at 10-year. Now 10 years aren't making new low, but they broke through that trend line, and we can kind of expand that out a little bit. And you can see what happened. It came up and reconfirmed the bottom end of the trend line today, suggesting that, again, this is a valid topping pattern, that yields are more likely to head lower than higher. How about the 30-year? Let's extend its line out as well. And lo and behold, it too confirmed its trend line today. And this is kind of normal when you see topping patterns. They break down, and then buyers, or in this case, when it's Treasury yields, sellers will push yields back up, try to break that trend line, and if it fails, again, it suggests that, again, in this case, 30-year yields are headed much, much, much lower in the scheme of a very large topping pattern. You've got people back all the way from, say, 2012, and let's draw a little line in here for fun, and you can see there is, this big topping pattern in the midst of this smaller topping pattern, which is why I am so bullish on Treasury bonds heading potentially to zero or negative. Because look, you have this massive topping pattern, and then you have this little topping pattern. Well, where do you think that's all going? It's not going higher. That's for sure. Let's take a look at TLT, which is effectively the inverse of 30-year Treasury yields. So if you're on the long side of the market and you're looking for duration, this is where you would end up being. And it broke. Okay, let's look at what we've got here. For those of you who are new, this is a supply zone up here. These two solid purple lines with this dashed, and this is a supply zone down here. You have sellers up here and buyers in here. That's why they're called supply zones. Think of it like a business, right? I'm selling a product, and I decide to list it at, say, $100. Well, there aren't many people that buy at that price point, so I have to lower and lower and lower to find where my buyers are at. That's a supply zone. So in this case, we have established zones where people want to sell when it gets to a certain price, and zones where people want to buy at a certain price. And so, a lot of people wonder how the markets work. It's a tug of war. You have buyers and sellers on each side, and then at one point, one side is exhausted. That's the side who wins. So if we see sellers exhausted, at some point in the future, buyers will take bond prices to new all-time highs and yields to new all-time lows. If sellers win, which is going to be pretty hard because they're going against the Fed, well, then that means yields are going up. So that's how you kind of look at these supply zones. And so we got into here, and I thought this was, I thought this was going to make a pretty quick move back up to the top of the zone. And why did I think that? I kind of felt we'd have some momentum on the bond market coming up here, especially with the big banks back buying as they did and the Fed buying as they've committed to. I just figured the sellers would run out of ammunition, and well, they proved me wrong. They got right up in here to this light zone of this zone of resistance, and they said, hey, we're going to put a stop to this, and let's zoom in, and we can see really what they did. They said, hey, no more. We're selling here, and prices popped overnight. Nope, selling, and then the next day, and sell, and they drove it all the way back down, and enough that I had to draw the line back in to the zone where clearly buyers are at, and buyers came in today. And we saw a nice volume, nice selling volume yesterday, but buyers came in, put a stop to it, and then buyers came in today and nearly got all of that loss back. And if we can get a push into this supply zone, which I believe, courtesy of the Fed, we will, and that's why I wanted to show you those QE auctions, because I'm really curious to see what will happen Thursday and Friday without the Fed intervening on a daily basis, if we'll see this push back down, maybe the 100-day moving average, or if, hey, maybe it doesn't really matter. But nevertheless, if we extend the line out, you get roughly this thing touch the bottom end of that trend line, and this should now act as a level of support to push bond prices high. We break out of the supply zone, you're looking effectively at new all-time highs there. How about emerging markets not validating any of the liquidity-fueled equity ramp, saying that, hey, we're not going anywhere, and emerging markets have definitely got an upper trend line that, if broken, could see, and which I do believe emerging market stocks make new all-time lows. I expect that. Now, a lot of people are like, hey, this gold thing is going up, and I think I missed the boat. And I said, well, remember, you've got emerging markets. Well, you've got another backup plan. How about silver? Silver ain't going nowhere. So silver is saying, hey, gold, I don't know what's going on, but I'm not with you. So if you feel like you missed out on one, you normally don't see the two move too far apart. And let's find out. Let's run a chart. And we got SLV. Yeah, you can see. So either silver is going to take a massive move higher, or gold's off its rocker. Kind of cool, huh? So we can kind of see closer in here. Then that doesn't really answer too many questions for me. But anyway, silver is way off on the big scheme of things, and should tell us that if you miss that play and you're super nervous about it, well, like I said, silver's gone nowhere. Emerging markets still's got a long way to go up, but I think emerging markets is headed way down in there somewhere. All right, let's see how much time we've got left, and let's pick up a question or two just for fun, see what we've got. Hi, Stephen. Thanks for answering my questions. Hey, you're super welcome. Another one came to mind. I've read many people say the Great Depression only became so bad because the Fed didn't react fast enough. And it was hard to go back in the past, but it seems to be the opinion of the majority. And now that they reacted so fast, there won't be a depression. Do you have an opinion on this? And if yes, what is it? Was the Great Depression only that bad because the Fed didn't do anything? I'm a history noob, so bear with me, please. Okay. I am not Ben Bernanke, Great Depression expert, but I have gone back and I do have an opinion on it. The Fed did act. They did lower interest rates. They actually did quantitative easing. And then at some point, they kind of, what you would look like, gave up. Now, why was that? Because we've heard from former Fed Chair Bernanke that they just didn't do enough. And they didn't do enough, and they didn't do it fast enough, hence your question. Here's what I believe actually happened. Is when there was that 1930s ramp in the market that was kind of fueled by the Fed's action that reversed and went, and stocks continued to crash, people lost faith in the Fed. Now imagine what happened now if stocks started to crash and kept going and going. The Fed turned up the money printer, right? And they kept going down. what happens? People lose faith in the Fed. And at that point, because we already know, because we've been through what the Fed actually does and doesn't do, and how what they do really doesn't do anything to help stock prices, what happens is when people lose faith, what's the point of continuing? And I think that's what happened in the Great Depression. It wasn't that they didn't do enough. It was that it didn't actually do anything, much like it's doing now, and they didn't jawbone enough. Clearly that wasn't a major policy tool back then. But once the market fell apart, it didn't work. Why do you think, when you hear, President Trump encouraging people to go spend, and you hear people inside the White House and other people tied to the government wanting you, me, but more you, because I don't feel like spending anything right now, to go out and spend, because they need the economy to start working, because if it doesn't work, then the emperor has no clothes, and you'll find out. One last question. Hello from Egypt. Hey, cool. First person I know from Egypt watching. Welcome. Some experts think that in 2 to 3 years' time, the relationship between stock and bonds will move in the same direction, basically against the traditional risk parity setup. I'll take you one step further, also against traditional asset allocation. Could you please comment on that in one of the QA sessions? Sure. How about this one? Will that work? Cool. All right. So here's what everyone's saying. What everyone's saying is there's going to be inflation, and when there's high inflation, interest rates are going to go up. And they believe during high inflation, the stocks are going to go way up too. Now, stocks are not always a guarantee under high or hyperinflation, but that's the belief. They think stocks are going to go up, and they think interest rates are going to go up because, well, that's pretty much how it works. And let's see. So stocks and bonds will basically move against the traditional risk parity setup. Yeah, so risk parity believes that if you're going to see stocks go up, you dump bonds. Well, what's going to happen, and that makes sense to me, at least that's my understanding of risk. Wait, you know what? I'm sorry. Risk parity is where you not equal weight. I get that confused sometimes with volatility controlled stocks. So risk parity is where you own not equal weight stocks, bonds, commodities, currencies, and you have a risk weighting for each of them. And so risk parity, and here's my opinion, risk parity, I've looked at the returns of risk parity. I am not impressed at all. Not even close to being impressed. I mean, in fact, I'm so unimpressed that I wouldn't even touch it. I mean, I got stuff that's way better than risk parity and with much less risk. Not that it's a sales pitch. I'm just telling you, I've looked at it and I'm completely unimpressed with it. So in that case, now let me rewind. I was thinking volatility controlled. So in terms of risk parity, which holds all those asset classes but weights them, yeah, it would be a drag on the risk parity portfolio. And that's only if we see high rates of inflation. I don't think we do under a current monetary construct. But if you listen to the recent Dr. Dark After Dark episode where Chris and I actually do talk about the reserve currency, kind of my thoughts on that and his thoughts on that, you'll maybe get some insight into kind of what we think or are concerned about coming forward. So again, I appreciate you taking the time to watch. Hit that link to check out Mark North. It's about a 20-minute interview with digital finance analytics on his show, Walk the World, where he interviews people from all over the world. I think you'll find that it's a great channel. And then later on, when you get a chance, check out the hour-long interview with Chris Dark and I. It's not really an interview, just more of us talking about stuff. And love to hear your opinion. Be sure to send those to him via Twitter. I will put a link to that. And if you can't get a hold of him, post it in my comments, send it to me, and I'll forward them on to him. I'm Steve Van Metre. Thanks for watching, and I will see you on Friday, where I can't wait to see what the credit data comes out. I know. You think, what a macro nerd. Hey, you know what? I'm good with that. The content of this video is provides educational information only. It's not intended to provide investment or other advice. It shows not to be construed as recognition or solicitation by Social Security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steve Van Metre on personal capacity. Opinions expressed in the video that anyone do not reflect the view of Atlas Financial Advisors Inc. or Steve Van Metre Financial.